Good morning, everyone. My name is Sakib Ryan, the oil trader here at JNF Capital. I'm going to be showing you some of the things I'm looking at this week as far as crude oil is concerned. The day is Monday, 16th March 2015. Basically, before I get started, please note, investing in the financial markets is not for everyone, okay? Losses can exceed deposits. Leverage is something that must be treated with respect. Now, basically, as you know, I always look for what is happening in the market in terms of bulls and bears, and my job is to keep things simple and align my funds in the same direction as the entity that is in control. So yeah, finally, oil has broken out of its range. It's been in a range for 6 weeks now. Been extremely boring, extremely quiet for 6 weeks, but that's something normal after a 6-7 month drop of 60% in the value of crude oil. So we sat sideways for 6 weeks, which is not bad. Finally broken out of it, so hopefully we're going to get moving now, and I'm going to give you a bit of an insight into what we're looking at. Okay, so what are the bears doing? Now, as you know, I've been bearish since June last year. Been bearish since the level of about 105.29. Market is currently trading in the 40s. Okay. Now, what are the reasons in current terms? As for what we're looking at. Let's have a look at the inventories. Look, last week we had the 9th straight week of builds in inventories. Okay. The API report came out on Tuesday, which is a report that's released by the American Petroleum Institute. That's a private report. That report indicated that there might actually be a draw, of about 200,000 barrels or so. So the market kind of stagnated, didn't do much. However, on Wednesday, when the official figure came out from the EIA, we had a build of somewhere in the region of about 4.5 million barrels. Now, that was in line with what we were expecting at the time anyway, okay? But the fact that the market didn't move as a response to the API figure the night before, this, we believe, it was the major catalyst for oil to start selling off and breaking out of the range it's been stuck on for the last 6 weeks. I mean, 9 straight weeks of builds. And that's one thing. Another thing we're looking at is, of course, the rig count. Now, admittedly, rig counts have been dropping. Okay, Baker Hughes have shown us that the rig counts have been dropping very, very steeply. Now, you would assume that, basically, when the rigs come offline, you would expect production to come offline as well. However, what we've actually seen is somewhat the opposite. Okay. Some of our data shows us that the US, Russia, Mexico, they've just recently increased production. I mean, for instance, the Americans have increased production by about 75,000 barrels, I think. So they're currently producing somewhere in the region of 9.35 million barrels a day. Now, that's exceptionally high for the kind of conditions we're in. That is a single aspect as to what the situation is. I mean, all that oil that is being produced is not necessarily being consumed, despite the fall in rig counts. To top it off, the actual storage capacity is shrinking very, very rapidly down in Cushing and in the other storage areas. Now, of course, excessive oil glut from OPEC and non-OPEC members, not enough demand. Okay, the dollar strength, if we look, this is a very big factor. Now, the dollar has been exceptionally strong. One of the reasons is, of course, is that the stronger the data gets, the more the market expects the Federal Reserve to move and raise interest rates sooner rather than later. Okay, and if you go back into history and you have a look at it, when the market fell in 2009 from somewhere in the highs of about $140, it capitulated down to somewhere in the region of $30. The US dollar played a big role in that. So commodities that are generally priced in the dollar, okay, tend to sell off. Why? Because the US dollar at the time in 2009 was still considered a safe haven. Okay, this is somewhat before around the region of when the QE started. Okay, or was about to start. But generally, when the dollar strengthens, commodities sell off. Okay, you would have seen that in gold as well. So these are some of the bearish things that we're looking at the moment. Inventories keep on building 9 straight weeks. Rig counts are dropping, but production is still increasing, and the dollar is excessively strong. These are the things that are basically forcing the market now. So as we stand, what are the bullish arguments? Okay, there aren't many, okay, out there, and I like it that way. It makes trading a lot easier when you can see that, you know, one side of the fundamental picture is heavier than the other. Currently, the bearish picture is a lot stronger. Now, what are the bulls doing? Okay, bulls possibly could be focusing on a number of things. Primarily, obviously, what the Saudi oil minister Al Naimi is saying and doing. Okay. What they're looking at is they're saying that their demand for their product is going to rise in 2015. We already know that. But what is very interesting is that they keep raising their prices of their product, you know, towards Asia and America. Now, why is that significant? That is significant because the whole reason Saudi Arabia does not want to cut production of their crude oil is to maintain market share. Because in 1987, when they did cut production, other members raised production and took their market share away from them. Okay, so this time around they don't want to cut production because they don't want to lose their market share. Now, how does that translate into what they're doing as far as raising prices is concerned? When they raise prices to Asia and America, if oil was to fall a lot further than where it is right now, generally whoever they're supplying to will naturally look for a cheaper supplier. Okay, so what this tells us, it just hints that the Saudi oil minister does not feel oil prices are going to go much lower from where they are right now. Hence, they're comfortable to raise the prices to some of their off-takers. Okay, couple of stats for you. Saudi is currently producing somewhere in the region of about 10 million barrels. And it looks like they're not going to change the rate of production from OPEC as well. That's going to stay somewhere in the region of about 30 million barrels. Okay. Another thing that bulls are possibly looking at is the IEA. They basically released a small note saying that demand forecast for 2015 is going to be revised upwards by 75,000 barrels as well. You know, and bringing their average demand up to about 93.5 million barrels. So yeah, those are the major things that the bulls could be possibly looking at as an argument. But you guys, as you can see, the bearish argument is far stronger, easier to decipher. And just to keep you in the loop, the next OPEC meeting is 5th June, and it'll be in Vienna. Of course, the smaller OPEC members, you know, the Nigerias and the lot, they will be negotiating pretty hard for a production cut. Okay, because they've really taken the brunt end of all this supply glut in the market. Their revenues are getting hurt. So, you know, some of the bulls who, you know, hoping for some sort of an indication from there, they'll be hoping that the argument the Nigerians and the smaller producers will present at the OPEC meeting in June will be somewhat significant and may persuade the Saudis and the bigger guys to cut production. Highly unlikely. Because Al Naimi has made it very clear that he wants to see non-OPEC producers cut production first. He wants to see people working in hand with them. So if other people cut production, other non-OPEC members, even OPEC members, if everybody cuts production unanimously, they will participate and they will cut production. But this time around, they're simply not going to be the ones who are going to lead the party into cutting production and then caught, you know, get blindsided again. So that's where we stand as far as the bulls are concerned. Okay, so what are my trading levels? For those of you who receive my oil report or have been in touch with me and either follow me on Twitter or something, you would have an indication of some of the levels that I'm trading around. Certainly if you receive my oil report, you will know what my levels are. Now, to give you an indication, last week when we finally broke out of that range, You know, I've been sitting around waiting for oil to break out below 49.90, and that finally happened. I shorted it at 48.16, and as I tweeted out my targets on Twitter, I was looking for 46.20 and 44.60 below that. Now, you know, had you been a client of mine, or you know, of ours here at JNF Capital, or you know, potentially even followed us on Twitter, you would have seen me tweeting out these levels, and you know, I've even shared my trade tickets on Twitter for you to prove that I actually took that trade. Now, 48.16 to say, you know, down to 44.60, it was roughly about 356 points. If you took profits early at about 46.20, you're looking at about 197 points. Now, had you traded this £10 a point, you're looking at what, £3,560 gross profit for the second target, and about £1,970 in gross profit for the first target. Okay, so of course there will be losses with our trades as well. I do have losing trades. You know, I don't have a crystal ball. Everything is based on analysis. Okay, and you know, of course there are downsides as well. But this is an indication of you know, the type of trades I am able to offer up. Now, in order to get my most recent trading levels, my most current trading levels, you can follow me on Twitter. You could, you know, occasionally follow me on Twitter, but you could get my oil report at the beginning of the week, which will show you my exact levels. I occasionally mention those levels on Twitter. I don't generally give those out, you know, without knowing who's reading them. So please get in touch with myself or one of my team members using the contact details on the following screen. And as I said before, you can follow me on Twitter. My Twitter handle is @OrionOil. So yeah, wishing all of you a profitable trading week, and look forward to seeing you next week.